Hey everyone, RJ Weiss here with GenYWealth.com. So today I'm going to talk about the 5 biggest investment mistakes that unsuccessful investors make. So let's get right into it. When I was starting out investing, I kind of had this preconceived idea that I thought I thought I knew what investing was. I was looking for a magic bullet. You hear stories of picking stocks and trying to time the market, and that's what I thought investing was, because that's what the only things I heard. So the more I learned, I kind of had this realization was, investing was really simple. All it was, say for me, it was just investing in a target retirement fund month after month in an IRA. So I was dollar cost averaging month after month. I automated my whole investing process, and that was a big realization for me, because investing, I found out, was really simple. It wasn't complex at all. So, I learned that many other people my age were having the same problem, and this is one reason why I started this blog, because, everyone thought investing was very, very difficult, but, I want them to have that same realization to me is, the difficult part is just getting started and, seeing how simple it is, because once you get started, it's amazing how much you can automate it, and, you can put it on the back burner. So, let's get into these mistakes that I see all the time of investors make, and these are some of the mistakes I made, when I was starting out. So the one thing I did, and I see a lot of people do, is avoid simplicity. So I chose to invest in a target retirement fund, and based on past history, it's an index target retirement fund based off of index funds, and I'm pretty sure it's going to be in the top 20% of mutual funds over the next 40 years. I know for a fact I'm not going to be in the top 15%. It's just not going to happen. It's an index fund. Over time there are going to be maybe a couple managers who manage, or a couple funds who can beat the market, but it's not a high likelihood. And in order to pick that fund right now and be invested at from the beginning is even a 1 in a million chance. So I'm taking that trade-off of getting a top 15% returning fund and just getting in 15 to 20% area, but I'm also foregoing the bottom 80%. So I think that's a pretty good and fair trade-off in my opinion. So next, let's talk about another mistake people make, is thinking way too short term. And this happens when the market fluctuates. And when the economy goes down, people withdraw their money from the market. And then when the economy goes up, people buy into the market. So what they're doing is buying high and selling low. So this is the exact opposite approach you want to take. And 18 months ago, roughly the market was around 70%, was down 70%, 60-70% to where it is today. And everyone who got out at the worst possible time missed that upswing. So, the market goes up fast, and you do not want to miss that. So you always want to be in it. You always want to dollar cost average into it. And you never want to get out based on fear. So, know your risk tolerance and always think long term. It's very important to think long term. The next mistake I see people make is waiting for the perfect time to invest. So this is, unless you're waiting to pay off debt, that's really the only time you're going to wait to invest. But right now, the other excuse I see all the time is, I'm waiting till my income goes up to invest. Well, you can start investing for as little as $50 a month in your Roth IRA right now. So that pretty much takes out the argument that you're waiting for your income to go up to invest. So, investing is just a habit that you install, and anyone can start that on any income. The only people who don't are, people living paycheck to paycheck, and that's no excuse. So the next mistake I see is people wanting it all. People wanting a conservative approach but still growth. People wanting to have income but still growth, which you can't have. There's no magic investment. There are trade-offs in all investments. So, make sure you evaluate your risk tolerance, and you understand that, if you want growth, you're going to need to take some risk. So the last mistake, and this is the biggest mistake I want to talk about, is forgetting about costs. And the costs that I'm thinking about are taxes and expenses. So I put an example here, which you can read below on the website. If you save $5,000 in a Roth IRA for 40 years and earn 10% a year, you would accumulate about $2.43 million. So if you saved that amount in a taxable account, you would only accumulate 1.2 million. All right, so that's about half. So next, let's talk about expenses. So say you save the $5,000 for 40 years, earning 10% is 2.43 million. If you earn 9% because of 1% expenses, 1% increase in expenses, that's only 1.84 million. So you're about $600,000 less there. A big, big difference. So taxes and expenses matter, and that's what, the last mistake I'm going to leave you on, and probably the most important, and probably what people mess up on most, is forgetting about costs such as taxes and expenses. So finally, I just want to make sure you understand that investing is very, very simple. Oftentimes, I confuse gambling with investing. I was gambling. I was trying to market time and pick stocks. That's not gambling. Investing is having a plan, going in there with a plan, dollar cost averaging month after month, and with little expenses and little taxes. So I hope this answered any questions and conquered any fears you had about getting started investing. Thanks, and have a great day.